I think we're moderately constructive for next year. And the reason is that ultimately we see a handoff from fiscal and monetary policy to the private sector. If you look at the state of consumers right now or the state of businesses, they both look pretty positive heading into next year. I think another way to sort of look at it is 2020 was all about PE expansion coming out of the downturn. And then if you look at this year, 2021, it was really EPS driven. So we've seen about a 45% growth in the earnings per share. And as we look ahead to next year, we'll probably see some moderation. We'll probably see PEs sort of stable or roughly stable with this year, but we're likely to see upper single digit EPS growth, which should provide some additional upside in equities next year.
Okay, so basically this year it sounds like was that multiple expansion that we hear about, the expansion of what the market would allow for price to earnings ratios, a little bit more comfortable letting them run a little hot because of low rates and growth. Next year going to be more of a fundamental story, actually looking at companies' income statements and balance sheets and saying, all right, you had a year, let's see what kind of earnings you can throw down.
Yeah, I think next year, again, the big story next year, well, the two big variables next year will likely be the Fed and inflation. And obviously, inflation has been top and center right now. On that front, our feeling is that while inflation right now is in multi-year highs right now, multi-decade highs, we're starting to see on the margins a little bit of improvement. And a couple of things for our viewers to keep an eye on. One is the inventory to sales ratio. Over the past year, business sales are up 15%, but inventories are up less than half of that. And if you look at the business to sales ratio, which comes out every month, we're starting to see some stabilization and a little bit of a creep higher. The other thing I'd point out, and I think you've talked about this in the past, is the Baltic Dry Freight Index. This is a measure of shipping costs around the country. And coming out of 2000, the Baltic Dry Freight Index was around 400, and it shot up to over 5,000, which is hard to believe. But just over the past few months or so, it's more than been cut in half. So we're starting to see shipping prices come down a little bit, and maybe that's a sign, along with the business to sales ratio, that inventories are starting to catch up a little bit, which should take some of the pressure off inflation as we head through the next year.
Yeah, also I'll see you and then I'll raise you a bit, Mike. The Drewry Freight Index, D-R-E-W-E-R-Y, not Mandy Drury. It's the Drewry Freight Index. It's still well above where it was a year ago, but it is down about 15% from its peak. So you think that maybe, just maybe, the superinflation story is starting to cool off a little?
Yeah, I think that's an important story, certainly. And the reason it's important is the two big variables, again, for next year are the Fed and inflation. If inflation stays around current levels, around 6% or so, or goes higher, I think that really puts the Fed more into play next year. And if the Fed becomes more aggressive in their policy, that could lead to a lowering or a decline in PE ratios, which could lead to some market volatility next year. So those are two of the key things we'll be watching as we head through the next several months.
Okay, so bottom line is you are mildly constructive, but you're not out pounding the table with some massively bullish call in the markets because it's going to be more of a sort of normalized year. Fair to say?
Yeah, I think there are plenty of risks out there. There's the Fed, there's inflation, valuation levels right now are not cheap. But again, economic cycles typically last a number of years as opposed to months or quarters. So barring the Fed really stepping on the brakes, which we think is probably unlikely, we think there's still moderate gains ahead in the new year. And the key is to be diversified. Right now, we're overweight tech, healthcare, and financials, and we'll be looking for growth areas and opportunities.